I'm Thomas Newhouse. I'm the president of the CFA Virginia, and I appreciate everyone coming out to meet live and in person. Today we're going to have three guests sit on our panel. Ashby Price will moderate the discussion, and I will introduce each panel member before we start. Lee Ferridge is a senior managing director and the North American head of multi-asset strategy for State Street Global Markets. Mr. Ferridge and his team formulate the foreign exchange, fixed income, and equity market views for all of State Street's range of clients. Say that 5 times fast. Lee joined State Street in 2008 and has more than 15 years of experience as a macro strategies and a proprietary trader. Chung Ma is the managing director of the Portfolio Solutions Group at the Virginia Retirement System. He leads the portfolio strategy, risk management, portfolio integration, and research teams. He serves as a member of the VRS Investment Executive and Management Committee, which oversees all the investment department's activities, and he's also the chair of the currency management team. And finally, Emily Weiss is the emerging market strategist for the multi-asset strategy team at State Street Global Markets. Her specific regional focus is Latin America. Prior to this role, Emily worked at the markets room of the U.S. Department of Treasury, where she was responsible for briefing senior officials on financial markets developments and providing policy advice on market-related matters. Emily holds a bachelor's degree in economics and international affairs from Northeastern University. Please welcome our panelists.
Alrighty, thank you, Thomas, for giving me an opportunity to eat for a minute. So, yeah, I want to thank the panelists as well. And when I asked Lee a couple of questions, you could tell that by his accent, he's a native of Richmond. So,
Richmond and Surrey.
Yeah, and Surrey. So, yeah, I'm going to ask a couple of questions, and then I want to open this up to the attendees as well. So, I want to start with the first question. For the panel, so the Russian invasion has obviously accelerated inflation, notably in fuel, given Russia's position as a large oil gas exporter. And so the Fed is continuing to prep the market for the faster slate of rate hikes and accelerated QT. Given that these are supply-side issues largely outside of the Fed's control, do you think they are capable of executing a soft landing, or are we just heading for stagflation? So, Chung.
Thank you, Ashby. Yeah, I would say let's just take a step back and level set to what has happened over the last few years. We've seen a lot of liquidity flush into the market. Risky asset prices have gone up, and now we're at a point where we're starting to remove some of that liquidity. I think the Fed is well aware of the impact that it has on risky asset prices. I think it'll be a dynamic and iterative approach that they're going to take. I think there'll be a lot of communication. Whether or not they can orchestrate a soft landing, I'm not going to make a call on that, but if you take a look at what's priced into the market, you'll see that over the next 18 to 20 months, rates pretty much hit a peak and then they immediately come down. So one can conclude from that, or a reasonable conclusion may be that there may be a policy mistake in there just because of the pace at which things are going up and then how quickly it starts coming right back down. So I would say that it's a watch and monitor approach. I think that's what the Fed is going to do too, right? They're going to make a move. They're going to see how the market reacts. QT is going to come into play. They're going to see how the market reacts, and then that will inform their next move.
Okay, great. Emily?
Yeah, so I think agreeing with Chung's point and just adding on a few of the things that we've been monitoring. So from our side, we've been somewhat surprised by how resilient markets have been, all things considered. Even though we've had some pretty volatile moves year to date, it does seem like that sort of buy the dip mentality is still there, despite the fact that we have this really dreary market backdrop of an ongoing war, the inflation issues, the supply chain struggles, and now the impact to growth. So when we put all that together, we're still sort of on watch, I would say, taking more selective risk-on bets, particularly because the idea of managing a soft landing is particularly difficult in this kind of environment, and there's a lot of potential for things to go off course, particularly when you have a Fed that seems like there's no doves left. It's all hawks. So we've been taking that approach of monitoring. We have a turbulence measure that we sort of watch to look at unusualness in market returns. That's all elevated. So the risk is there that the correlations are elevated and there's potential for things to start to fall apart quickly, but we haven't started to see that yet. So it makes for a really tricky environment, I think, in the next few months.
Yeah, I would agree. I mean, I think generating a soft landing at the best of times is really, really hard. We talk about this soft landing. Tell me when we've had a soft landing in the past, particularly when you've got inflation at 40-year highs. It's almost impossible, I think, for them to and I agree with what Chung says. I think we are going to see sort of a lot of communication. We're going to see shifts in stance, but to know exactly when to stop the tightening, given monetary policy acts with a lag anyway, I think is really, really hard, particularly when you're faced with this inflation challenge they've got. So we've got 9-10 hikes priced in for the next 12 months, 8.5 by the end of this year. I don't think the Fed are getting anywhere near that. I think we'll probably get 4 more hikes, and I think by Q3, what you're going to be seeing is core inflation will have come down quite sharply. Headline might still be high because of what's going on in Ukraine and what that means for food and energy prices, but I really worry about the consumer. The consumer is getting squeezed. You look at the last inflation print we had, the one this week. So core inflation, or if you look at the headline number, 90% of the inflation we saw was actually driven by categories that are no choice categories. You have to spend. So it was food, it was energy, and it was shelter. If you look at discretionary sectors, actually there's signs of price weakness already. Goods prices dropped. So, retail sales today, another miss on retail sales today. So the last two, the control group, where you strip out a lot of that, a lot of the noise, has been negative for the last 2 months. And don't forget with US retail sales as well, that's a value number. The US is the only country that produces retail sales as a value number rather than the volume number. So every other country, it's volumes. In other words, you adjust for prices before you say what retail sales is. In the US, you don't. So you've got an inflation element and you've got a demand element in the retail sales report. So basically, if you look at nominal retail sales are negative, well, real retail sales are much more negative because of the inflation. So you're already seeing the consumer start to struggle. And I think that, but the Fed is laser focused on inflation for now. They will be for the next few months at least because the headline number is high. But to sort of manufacture that to a soft landing, it's going to be really, really hard.
Could I comment
Yeah,
on? Yeah.
absolutely.
So to echo what you just said, I mean, if you take a look at this past week, I think demand is certainly softening. I mean, CarMax, a local company, missed big on its earnings, right? And it was based on used car prices were really high. That led to softer demand on it.
Yeah.
And also, if you overlay what's going on from a business cycle perspective of we're either mid, late cycle, I would say, depending on who you are, I've been hearing more late cycle as earning revisions trends are going down, profits are starting to get squeezed. And that adds another level of complexity to the Fed because there's just so many things going on. And just to use an anecdote, they're already juggling a few balls, and people are just throwing in balls left and right now. And I think it is going to be hard to engineer that soft landing.
The bottom line is, the Fed is not as smart as we think it is. It's got, they're smart people, don't get me wrong, but in terms of actually knowing the right time to do things, if the Fed was that smart, we wouldn't have had the dot-com crash, we wouldn't have had the financial crisis, we wouldn't have had various things along the way. Because it's not to criticize the Fed really. It's almost impossible to know. So you manage the best you can with the information you have, but to be clever enough to look 18 months ahead and manufacture this soft landing, particularly when inflation's here, really, really hard.
Thank you. And Lee, remember, this is being recorded, so just watch what you say.
Yeah.
In case Powell's watching. So what are your thoughts on the ECB, given energy issues and sanctions in Russia and not going away? Just want to hear your thoughts on the euro and Eurozone growth, and is ECB at risk of a policy mistake?
Yeah, in the same way as the Fed. I mean, exactly the same situation. Harder for the ECB because you've got 20 odd different economies going on there. But today we had the ECB today, and they're a bit more dovish than expected. So at the moment, it's bizarre for the ECB actually that they are dovish. You've got inflation at 7.5%. You've got interest rates at negative 50 basis points. And the ECB isn't like the Fed. It doesn't have a dual mandate. So the Fed has a mandate for stable prices and maximum employment. The ECB only has a mandate to control prices. They don't have a growth mandate. They just have an inflation mandate. So you're at 7.5% with an inflation target of 2%, and you've got negative 50 basis points. By any recognition of the ECB's charter and everything else, they should not be doing what they're doing now. But again, they're trying to look through this. They know the disruption to the economy from what's going on in Ukraine, which is obviously much more direct. If the Europeans and the world is forced to cut off oil imports from Russia, that adds a whole new level of complexity, and I think eventually they will. And Emily showed me a story just before we sat down that apparently they're starting to work through the paperwork of how to do that, and I think they have to. That makes it really hard for the ECB. So again, they're trying to look through this. They're focused on, at the moment, the slowing growth rather than the peak in inflation. I think that's the right way to do it, to be honest, because I think inflation will take care of itself because you're going to get demand destruction anyway because the consumer is so squeezed. But yeah, it's sort of, they are clinging on by their fingernails to this dovish stance they've got. But today's press conference surprised a lot of people because they're carrying on being dovish. And the euro has suffered as a result. I like the euro as a currency over the long term because I think Europe runs a massive current account surplus. The US runs a massive deficit that's getting worse. You're going to see reserve diversification away from the dollar. So long term, I like the euro. Would not touch it at the moment, not with what's going on.
Yeah, and I'll just add on to that point on the euro because we were looking at this a lot when it came to the crisis initially sort of breaking. It seems like that whole Russia-Ukraine situation, while still really pertinent on a humanitarian level and obviously still a crisis, has fallen a bit to the market backdrop at times as markets have tended to look at things with the glass half full. So we've been a bit surprised by that, just given that there's still a lot of potential risk factors here, particularly as Lee mentioned, a ratcheting up of sanctions. One of the graphs that we had been looking at was looking at different countries' proximity to the conflict relative to how their currencies have performed. And it really is the kind of thing where the countries that are closest to this issue have seen the biggest impact negatively in their currency and equity markets. So it remains a very regional issue, and I think that's going to be a major issue for Europe as they look to navigate a soft landing with the additional complications on the growth side.
I'll add a couple of points here. Wholly agree with Euro. I think longer term, I think it is more attractive than the US dollar. Shorter term, same thing, we wouldn't touch it. And I think our portfolio decisions have reflected it in the currency management team. One of the things we do is we look at hedging at a fund level. So what we've done there is we've actually removed our hedge there, basically moving to more of a pro-dollar position. And we did that towards the middle of last year, and we maintain that right now just because of all the uncertainty there. So you kind of have the U.S. safe haven, you have the uncertainty of monetary accommodation being removed, you have QT coming in, so you have a lot of uncertainty there. And with all those things in the mix, we thought there was a bias towards owning dollar versus foreign currencies. A second thing to echo off of one of the comments is I think people are underestimating the impact of the Ukraine-Russian conflict on Europe, especially as it pertains to the energy transition. A lot of money was spent, a lot of investment was spent with renewable energy, green energy, and very little investment was spent in traditional fossil fuel energy. And as you saw as a result, they're in a bind right now. They still need to buy oil. And I think they're still buying from Russia right now. So I think that's going to have an impact. From extending that out to an equity perspective, if you take a look at the broad European market and the broad US market in equities, if you look at it from volatility terms, realized volatility for broad European markets tended to be higher up until the pandemic, right? And when the pandemic hit, S&P vol realized higher. But now we're moving back into what we saw pre-pandemic, where European volatility is priced higher. And I think a lot of that is driven by what we're seeing with the Ukraine conflict, and that's surfacing a lot of the vulnerabilities in the economy right now.
And actually, Chung, you just made me think of a point, that divergence between short-term and long-term. I mean, certainly Lee laid out the more bearish case, the near-term, but over a much longer time horizon, our team actually had more of a theoretical discussion about whether we could see some sort of change in reserve assets. And it's always trendy to talk about whether the dollar is losing its status as a reserve currency. And usually the currency that's brought up as a comparison is, okay, well, maybe China will start to overtake that sort of holdings. And instead, actually, we were looking at the euro coming out of this crisis as potentially having more legs to take over that spot, given the more unified front that's been put forward, the spending plan that's been announced, and sort of more of a contender to having that top spot. So much longer time horizon, but could be a positive lining.
Okay, great. So when you look across the emerging markets landscape, what opportunities are you seeing currently? And then do you still see value in commodity exporters given the outperformance so far this year?
Yeah, so I can take
That's
that
all
one. Sure. Yeah, so we do. We are still following the commodity story quite closely. As I mentioned, we don't believe that, unfortunately, this conflict hasn't fully run course, and we're still looking for this to be a theme headed into the rest of this year. Now, on a weird side, I mentioned the proximity dynamics, keeping us more cautious on the CE3 countries in Central Eastern Europe. But at the same time, there have been some strange beneficiaries to this, particularly commodity exporters. And when we look at how GDP is adjusted, GDP forecasts for 2022, there are some countries that have seen net revisions higher because they're having improving terms of trade and their commodity exports are benefiting countries like Colombia, Chile, Malaysia even. So keeping those sort of nuanced takes in mind, it hasn't been completely risk off in the EM environment so far year to date. So we're continuing to look for those countries that may be able to weather some of this storm and might even benefit on the commodity side.
Okay, great. So ESG is a hot topic now and very much a focus. So the SEC has proposed some new climate disclosure rules. How do you envision ESG metrics are built into the investment process in the long term?
So I'll start off with that. So ESG is a very important topic, and it's in the press a lot, and it's something very important for us as we're managing portfolios. Most of our managers, our external managers, have an ESG policy. One of the things that I think is limiting progress on this, and I think Europe is doing a much better job of this, is the collection of data and the regulatory landscape around it. Because when we look at the data now, companies aren't, they don't have to send data in a standardized form, let's say, right? So basically, whatever data sets are out there, it's kind of garbage in, garbage out. We do think that this will progress. I think the SEC continuing down this front is progress. Internally, what we're doing is a couple of things. One of the things is we have groups of people who are dedicated to analyzing the data sets around this right now and better understanding the academic literature around that. We are looking at it from a governance perspective in terms of proxy voting and other areas. We're also doing some toe dips in terms of investments as well. We have some climate transition mandates, and part of that is just getting our hands dirty, trying to understand how these strategies are trying to capitalize on this situation. And we don't think from an ESG perspective, let's say from a climate perspective, that exclusion is the right choice, because if you take a look at last year, the best performing sector was energy. It was up 55% last year. So we want to be able to play both sides as this transition happens, and we think there are plenty of opportunities within this energy transition.
I mean, I think from our perspective, it's obviously a huge area for us. So at State Street, we're unique in a lot of ways compared with other banks, because we rely strongly on academic partnerships. So being based in Boston helps with that. So with ESG, we tied up a few years ago with Professor George Serafim from Harvard. And so we work very closely with him on various ESG products, ESG research. It's not my area of expertise, but we have people within the team and within State Street Associates, our sort of academic think tank, that cover it as well. The biggest challenge, though, and this was actually one of our other academic partners, Roberto Rigobon at MIT, pointed this out to me. If you look at ESG ratings against, say, credit ratings, so if you do a scatter plot of credit ratings against the credit rating agencies, they're all pretty much in line. You do ESG against all the people who produce ESG ratings, it's completely random. There is no relationship between different companies and how they view the different rating agencies and how they view the same company. And that's a big issue for ESG at the moment. You need to get some sort of standard, and this is the sort of work that George is doing, some sort of standard measure of where are we on where is this company on the ESG scale? What's more important? Is it gender diversity? Is it carbon? What is it that's most important? And all the agencies rate these things differently. When it comes to credit ratings, everyone knows what you're doing. When it comes to ESG, no one does, and that's a big area for us that we're looking into, a big area of research for us.
Yeah, and that's a really good point there. And said differently, ESG means different things to different people, right? So you could be looking at the E part, you can be looking at the S part. I would say, like, the G part has been a part of at least equity investment management for a long time, but I think the S and the E, they're probably more in its nascent stages. S more nascent than E. I think a lot of focus is on the E part right now, as with the SEC, with Europe, and I think more asset owners are looking more and more and spending more time in this area.
So what trends are you seeing with your clients that you're able to share?
Yeah, I mean, like we've been saying on this panel, it's hard at the moment. I think one thing I would say is increasing nervousness is definitely something that's coming through. So, we again, the State Street, part of our academic partnerships, we produce daily indicators for real money investors. We're the biggest custodial bank in the world, and for the last 25 years, we've produced a range of indicators telling us what real money investors are doing from our own custody accounts. So what are they buying, what are they selling, how are they positioned, they overweight, underweight assets across FX, across equities, across fixed income. And one of the products we have that Ken Fruit at Harvard produced was something called the Behavioral Risk Score, which it looks at all these measures across asset classes. Are real money investors, and it's sort of 22 different measures, are they buying risk or are they selling risk? Are they cautious? Are they optimistic? And you add it all up and you get a number. So the Behavioral Risk Scorecard turned negative on February the 4th and has basically been there ever since. And that run, we had one day last week where it went positive and it's negative again now. But that run, it doesn't sound like much, but it was 42 days, was the longest run in negative territory we'd seen since 2016. Even during the pandemic, we didn't get as long a run of negative sentiment readings, because when the pandemic happened, you got the central banks reacting. So the central banks, you had this huge policy input, you had the fiscal input, and so, sentiment picked up again. This time around, you had the war in Ukraine and central banks tightening, and this is the issue. So what I would say is, the biggest thing that's coming out for me, and Emily mentioned before our turbulence measures, which look at, price unusual correlations in markets, price volatility, etc. That's at its highest level that we've seen since the pandemic, and before that, since the financial crisis, we've not seen them up at these levels. So there's a lot of nervousness out there. You see it in prices and you see it in flows. And I think that is something that, as we go into the summer, as the Fed carry on tightening, maybe as the economic data starts to worsen further, it's going to be a cautious time. And as Chung has mentioned a couple of times, QT, quantitative tightening is huge. We saw it in 2018 and the impact it had in 2018. It's going to have an even bigger impact this time. Not yet, but at some point QT is going to cause markets some real problems.
Since I'm a consumer of State Street's research, I can share what I'm asking them. So turbulence is actually one of the measures that we use as part of our process of risk management. So that's actually one thing that we put in there, and we observe on a regular basis and have conversations in-house. I just lost my train of thought.
We didn't even tell you to say that.
I know. that was for the launch. I'm sorry, I just lost my train of thought on that.
Well, I can add in a few, and then if you want to pick back up again. But a few things that we've been back on the road doing client meetings again, so that's been exciting to get back in front of people. And a few things I think that have stood out on top of the nervousness that Lee mentioned and the sort of selective risk-taking that I mentioned that we're seeing in our data flows. It was interesting to me how every single meeting, kind of like at the start of our panel, everyone agreed the Fed was set to go too far, too fast, and yet everyone thought there was no other way for them to go. So it seems like that's a pretty consensus view. The second thing we talked a lot about, particularly on the EM side, was about the political risk front. We mentioned the U.S. consumer getting squeezed, but it's certainly true on the EM side as well, where we have food inflation and fuel inflation rocketing higher according to our price stats measures, which basically does an online gauge of prices and tracks that daily. That really hasn't turned at all on the food and fuel side, so still going higher there. And on top of that, EM central banks have been just as restrictive, if not more proactive, in the likes of Brazil and other countries in terms of combating inflation with rate hikes. So when you end up with both sides of those equations going at full speed, I've been getting a bit more worried about the political tensions and how that could spill over. We've started to see that in Peru, where we have some protests around higher prices, but I think we'll likely see more of that going forward.
Yeah, I'd agree on that. I mean, if any of you can remember the Arab Spring back in 2010, in Egypt and various countries in North Africa, that was all triggered by food prices. That was triggered by people not being able to afford to eat. And I think that's one of our concerns over the next few months. Emily mentioned Peru. You've also had demonstrations in Albania. There are things coming through. And the food price effect of Ukraine, we haven't really seen yet. Because, fuel prices react instantly, right? As soon as the oil price goes up, you see it at the gas pump. But food takes longer to come through. Ukraine and Russia, between them, export 30% of the world's wheat. They export 30-odd% of the world's fertilizer. So that's going to hurt crops going forward. And this is something, so food prices are probably set to continue to move higher. And yes, it's bad for consumers in the developed world, but it's a lot worse for consumers in a lot of emerging and frontier markets where food is a much bigger part of the consumer budget. And that's an area I think we're growing concerned about.
Yeah, the fertilizer story is something that I don't think gets enough press because we're not seeing that come into play yet, but it will as it over the next 6 months, over the next year. And echoing the sentiment there, as an asset owner, I would say a general observation across our managers is that there is less risk-taking. Right? So depending on what their mandate is and what their risk budget is, most have brought in their risk. So even though they may be more pro-equity and they're funding that from fixed income, relative to what their range of risk has been, they have brought that down. Right? And obviously there's some managers who are looking through this, but I would say a general observation is everything's coming tighter to benchmark right now and neutralizing some of the risks and really observing what is going to be the impact of some of these early hikes.
Well, staying with emerging markets, with China, they've had more lockdowns recently because of their COVID policy and zero tolerance. How do you anticipate that these lockdowns will impact the supply chain and also inflation in the future?
Inflation's going to go up. Be ready.
Yeah, not a lot of bright news for inflation. So Lee and I put out a piece every other week that's titled Alt Data Weekly. We look at essentially lockdowns and COVID cases. And we've tried to stop publishing it twice now. And both times have been thwarted by rising COVID numbers. The most recent one being around China. And when we started looking at the numbers, we realized we couldn't stop publishing COVID data right as there was a pickup going on in Asia. So that's something we've written about a lot. Obviously, the lockdowns in China are of a more extreme nature. We publish data on terms of Google mobility for a lot of other countries. And what we've seen there is that people are still generally doing retail and recreation activities to a certain extent back to normal, but workplace travel hasn't resumed. In China and other select parts of Asia, that's obviously dropped off in some major areas. And there's one graph we have from one of our coworkers in Hong Kong looking at what share of Chinese GDP comes from all the different provinces and ranking those provinces in terms of COVID cases, whether they're seeing high amounts or low. And some of the largest contributors to GDP in terms of provinces are seeing some of those major COVID case lockdowns. So that is an area of weakness, just to add to the picture that we've already talked about in the US and Europe. And what's been somewhat perplexing to us is that we haven't seen more stimulus come out from the authorities in China, so that monetary and fiscal conditions remain relatively tight compared to what we would expect. So we keep expecting that to change coming down the pipeline, but it hasn't happened yet that it has enough of a meaningful effect to change our view.
Okay, I'll ask one more, and then I'll open it up to the group. So, given everything that you've discussed so far, and the S&P already declining, about 8% so far year to date, what do you think would need to occur in order to accelerate depreciation in U.S. equities?
I think from my perspective, it's fairly clear for me, and it's about real rates. So if you look at, equities have been sold off in Jan and Feb, and they've been remarkably resilient since then. But it's because when you look at long-term real rates, they're still negative. So 10-year real rates now are about minus 17, 18 basis points. Even though nominal yields have gone up, real rates are still negative. So long as real rates stay negative, you get back to the Tina trade. There is no alternative. I have to be in equities. I can't be in bonds because real rates are negative. So, I looked at the last time, and this is where QT comes in and is a major thing. So I looked back in 2017 and 2018. Equities are fine until real rates get up to about positive 100 basis points. In actual fact, if you go back over the last 10 years, and I looked at performance of equities against long-term real interest rates, as long as real interest rates are below 50 basis points, equities perform well. Whether they're negative or sub 50, they perform very well. 50 to 100, it gets a bit shaky. Over 100, you want to get out, right? The returns are horrendous, above 100 basis points real yields. Now, that's over the last 10 years. I suspect this time the threshold might be lower because the equity valuations are so much more stretched than they were previously, even in 2018. So I worry that maybe it's 50 basis points on long-end real yields, but that's what you need to watch. Rather than nominals, watch reals. So, nominals less the break-evens, it gives you that long-term real rate. We were minus 100 basis points at the beginning of March. We're now minus 16 basis points. So the direction of travel is clear. But until we get to that, probably plus 50, equities should hold in okay. But once we get above there, I will be really nervous.
I'm gonna approach this a little differently, rather than looking at it from a beta perspective, and I'm gonna talk a bit about active management here, because I think active management I think we're past the time where there's easy beta. I think that was the last 10 plus years when liquidity was getting flushed into the system. Now, when the punch bowl is being taken away, there's gonna be a lot more dispersion in returns, and that is precisely the time where active management can succeed. So just to think of it another way, so if the S&P 500, if every stock in there went up by 10%, at the end of the year, your active manager will lose because you're paying your active manager fees, right? So when you start getting dispersion of returns, because some companies may have more pricing power, some companies may have less pricing power, new product development, found a new vaccine, hopefully no more vaccines, but with that, you're going to start getting dispersion in stock returns. And I think that's when skill is really going to start rising to the top. I think over the past 10 plus years, it's been a beta game. I think it's completely different now. We're moving into an era of active management, and I think that's when active managers are going to earn their keep right now. I would say it's hard to say where the direction of equities will go in the next 6 months. Next 12 to 18, I would argue it would go up. The longer it would go, I would argue it would go up. But this is precisely the right environment where active managers can really earn their keep right now.
And this might be a more second-order impact for U.S. stocks, but in terms of things we're watching in Russia from our analyst who follows that quite closely, the first being that one of the reasons we haven't seen more fallout and more systemic risk from that crisis has been that the oil and gas has still been flowing. So to Lee's point, if we end up with further sanctions from Europe that stop that flow of gas, or if Russia decides to cut off the flow of gas, that would be another, in my mind, leg to watch for risk assets. The second thing being on the default side, not just sovereign defaults, but also corporate defaults in Russia, which there's a lot of payments coming due in May in particular. That has the chance to have more ripple effect for any companies that might have exposure to Russian corporates still.
Okay, I want to open it up to the floor. So anyone have questions? Vernon?
Thanks, Evan. Do you have a view on the different equity sectors in terms of how to play the equity markets these days?
I'm not an equity person. I'm a bond and FX person. I mean, I would agree 100% with Chung, though, that this is time for active management, but you've probably got more of an idea on the sectors than I do.
I would say from an equity perspective, I'll answer that in a couple of ways. So some of the things we've done in terms of exploring different opportunities is we've increased exposure in more concentrated portfolios. Like most of our portfolios tend to be very diversified across sectors. But so, for example, recently we engaged in a healthcare mandate. More broadly, I would say your question also touches upon this value versus growth, right? And that's a really interesting one, because just like many people define ESG differently and it means different things to different people, value and growth are very different. There's the naive approach of let's just take MSCI or Russell. You take the value and you look at growth, but then if you peel back the onion on that, you're really just making sector bets, right? You're going long financials, energy, healthcare in your value basket, and in the growth basket, you're going long tech, consumer services, consumer discretionary, and telecom, right, or communication services, the new name. So one of the things that we've done is we've removed that sector, or we've looked at it from a sector neutral basis. And we're trying to extract out the essence of value. So country neutral, sector neutral, and we're taking a tilt towards value. And we're doing this at the fund level. And that's one of the things that we've been doing, where each of our programs will construct their program portfolio based on their benchmark. But at the fund level, we'll start doing some overlays. Like if we see an attractive opportunity, we'll move forward in that. So that's one of the things we've done from this value and growth thing, where we're extracting out the essence of value and not taking any of those sector bets.
I will say our equity team that we do have, healthcare is one of their favorite sectors right now. Healthcare and energy, I think, too. Do you remember any others? I think those are the ones, right?
Those are the ones, yeah.
Yeah.
Hey, excuse me, two questions. One, Lee, would you mind, there are two things that you said I kind of want to synthesize or correlate or whatever. One was the comment about, the market's pricing in like 9 or 10 interest rate increases. We think it's 4 or 5. Then you offset that with what you said about real rates. Like, so what would happen if we only do 4 or 5 cuts? How does that does that snap that back? Does that make that worse? I would love to hear something like that.
No, because the other element here is quantitative tightening. Okay. So what happens with QT, if we only get the 4 hikes, that doesn't really, if we're getting QT at the same time, you'll actually steepen the yield curve. So if quantitative tightening acts as a substitute for interest rate hikes, you'll steepen the yield curve, but if the economy is slowing, you're still going to see inflation expectations come down. So You're going to have this situation where why are the Fed only doing 4 hikes? Because the economic data is deteriorating and maybe longer-term inflation expectations are falling. So break-evens are coming down, but long-term rates don't come down because you're doing QT. So actually, the combination of QT with a backdrop of a slowing economy actually pushes real rates higher. And this is the curious thing you get with quantitative tightening. So that's the bit that concerns me. This is what we saw in 2017, 2018, that when real rates went higher. That's the curious bit you get to, that you get higher nominal rates, but you get lower break-evens because you're more pessimistic on the economy. So that's, as Chung has said, we've had the last 10 years has all been about liquidity. We've taken the Fed balance sheet from below $1 trillion to $9 trillion now. We've taken the G3 central bank balance sheets from 4 trillion to 28 trillion, right? That's why everything's gone up. So that's why real rates have been negative for so long, because you've had this huge amount of liquidity. Well, if we now start to take that out at a time of high inflation, when you're going to steepen that curve up, then I think that's when real rates rise.
I want to ask one other random correlate. I feel like we've talked around Brazil a little bit.
Yeah.
I was just looking at the, the kind of currency rate. I mean, it is breathtaking how
It is.
the correction this year. Can you just talk a little bit more about that? I mean, we think about, between the Petrobras, all their kind of South America's breadbasket, just a little bit more on Brazil.
Yeah, of course. One of my favorite topics. A great question. So Brazil has been a really interesting story, particularly the real year to date, where we've had this massive rally. And it's especially impressive to me in that we're in the context of an election year, where we're potentially switching from one extreme candidate to another extreme candidate who we've seen before. So in that context, it's really been quite shocking. Now, where it hasn't been as shocking is partially on the real rate side, where what we've seen from the central bank is a really aggressive tightening of rates headed into this year, bringing the Selic rate up into double digits. And so from that front, even though inflation is high, they have provided some sort of built-in cushion, I think, where Brazil, the central bank, really led the charge of this central bank rate hikes. And I think will be set to kind of continue hiking despite the fact that they're looking to soften up a bit more going forward. The election risks are still very pertinent, and we have a few traders in Brazil who are always kind of giving us the rundown. It just right now seems a little bit too far away for the market to focus on completely. We'll probably get more of that going forward. But we have seen a trend of, in Latin America, more sort of left-wing candidates being elected, and actually that being taken as a net market positive. So it will be interesting to watch going forward. We're a bit more cautious down at these levels on the currency and the equity markets, and looking to play it through other currencies or other equity markets. Colombia is one that we really have been zeroing in on as a potential alternative. But it's been pretty impressive so far this year in Brazil. Thank you.
Thomas.
I think Sri Lanka defaulted on some bonds yesterday or the day before, and I'm always trying to bring it back to the U.S., and it seems like the U.S. financials are in great shape in terms of balance sheets and so forth. Is there a risk that you get kind of a Asian contagion from defaults that then comes back to the U.S. banks? Is that something you're worried about?
I can't say. So most of the risks that we've been looking at, or most of the questions we get, I would say, have been from the risk of spillover effects from China, in terms of whether some of what we saw earlier at the end of last year into this year could potentially come back in terms of the housing market, other areas like that. In terms of Sri Lanka, I'm not sure that necessarily moves the needle, but I get your point in terms of seeing how U.S. financial markets are more insulated. I think at this point, my sense is that there's a pretty good cushion there, but I'll give over to Lee to see if he has any other thoughts.
Yeah, I think so. I mean, as you said, the U.S. financial condition is arguably as strong as it's ever been. I think the interesting thing with emerging markets, and Emily, you can correct me here if I'm wrong, is over the last 10 years, what you've seen is a lot more of the debt is in local currency terms rather than in dollars. So the risk of default goes down substantially when it's in local currency. Sri Lanka is not one of those. Sri Lanka is a frontier market. Their debt was in dollars or in hard currency. So I'm not worried about a string of defaults across the EM world because it happened in Sri Lanka. It's something to be cautious about. But I think the reduction in local currency debt, certainly at the sovereign level, or the reduction in hard currency debt at the sovereign level, is something that gives an area of cushion as well.
Yeah, to your point, Brazil, the debt to GDP of above 100%, and yet mostly in local terms.
Yeah. And you can print your way out of that.
Yes.
Maybe sticking with the default theme, and we saw the U.S. speculative grade corporate default rate be pretty low during the pandemic because of things you touched on with the liquidity and rebound. But do you guys have a view, near term, longer term, on when the default rate for U.S. Speculative grade corporates comes back up to something more normal?
John, you got real on that?
I don't have a strong opinion on that one.
I don't have a strong opinion either. I mean, I think, as with the equity world, when you get this removal of liquidity, then you're going to see pressure on default rates. You're going to see pressure on credit spreads to start with. Now, one thing I would say is, during this era of ample liquidity, two things have happened. One, the duration of corporate debt has increased, which obviously makes them less vulnerable to near-term increases in credit spreads. But two, we have seen a massive rise in zombie companies. There are a huge number of companies out there that should not exist, where, in the definition of zombie company is that their revenues do not cover their debt payments. But when you've got ample liquidity, too much liquidity, they can always refinance because people want yield. People are desperate for yield anywhere they can get in. So what you've seen is, one of the side effects of quantitative easing and ultra-loose monetary policy, which is the era we've been in since the financial crisis, is you don't get creative destruction in the economy. You have too many zombie companies. That lowers productivity. And the thing is, I was doing a presentation a few years ago called Keeping the Plate Spinning, which was about central banks, some of you might know, which was about central banks, basically the whole structure of monetary policy being too loose. And it was like the stage act with, the guys with the plates on the sticks and they run around and keep it going. That's what they were doing with asset markets. And it was inspired by 2018 when we saw the big sell-off. Suddenly the Fed did a complete about turn. December 2018, they told us they were going to hike 3 times in 2019. They cut 3 times. Talking about going back to the question earlier about the Fed and how smart they are. But the point there was that you've had this period of excess liquidity. They've kept the plate spinning. And you can carry on that game as long as there's no inflation. And that game has gone on for 30 years because we've been in an extremely low inflation era, and we can talk about why, and globalization, inequality, etc. But the fact is, that's the era we were in. So you can keep the game going. You can try and moderate policy, but as soon as there's a crack in the markets, they back away. This time again, how quickly does the inflation come down? We're in a different environment. I think the duration of the corporate debt means you're not going to get that range of defaults, but the longer it goes on, then obviously those risks go up because there are a lot of companies out there that should not exist anymore.
Yes.
So you've talked a bit about cracks in aggregate demand and defaults and zombie companies, and I'll probably take some Prozac afterwards.
Put it in context, I am English. We're a miserable bunch, you got it now.
I was about to say you're a debt guy and you're supposed to be like that. So, but what could be upside surprises in your forecast? What could go right?
No, I'm not good at upside surprises.
So let me take a stab at this one, because I was having a conversation yesterday because in the office we were all talking about doom and gloom scenarios. I think there could be some support in the second half of this year for risky assets if inflation comes in lower. Yeah. We already saw a smidgen of that with core coming in at 0.3 versus 0.5. Lee alluded to it earlier about the pressures potentially coming off at the second half of this year. If QT is not overly strong, we're in midterm election time, we could potentially see some support there. And also, I think the real rates argument is a good one. If that's well behaved, I would say you probably could get support there, because if you look at the overall economy, growth is relatively strong. It may be slowing, but it's relatively strong. Earnings margins are probably close to peak now. Maybe it continues, especially firms that have pricing power, right? If they're able to pass that on down, that's a big plus. if we see earnings revisions stabilize, I think that would be good. We're starting to see some of that downtrend now, which isn't a great sign, but if you start seeing that stabilize, I think that could be a plus. China comes out of this slower, maybe they change off of this zero COVID policy or change more from the zero COVID policy. You could potentially see some upside surprise. With that in mind, I would not say we would be going back to the past year or the previous year's equity returns, but I could certainly see a more sanguine outlook if those things occur.
Less bad.
Yeah. Well, yes.
Yeah, well, I guess one point on that in terms of less bad, I mean, US GDP forecasts are coming down for this year, but they're certainly not terrible. Like, we're still expecting solid growth this year, and we do still have a really low unemployment rate. The Fed somehow thinks they can hike and maintain that low unemployment rate. That would be the Goldilocks scenario, if it's just a growth slowdown and not a full-on recession.
There was a paradox in what you said as well, though, because you were talking about inflation coming down, but then you like companies with pricing power. We've sort of, you've got that tension all the time. You want inflation pressures to come down, but you've got companies with pricing power who are going to stop it coming down. This is the problem. I mean, I think the crux of it is, and I would agree 100%. If inflation comes down quite quickly from here, now core is going to fall fast in Q2. Because if you look at the month-on-month change in core, we were 0.3 for March. You look at last year, April was 0.9, May was 0.7, June was 0.8. If we stick at 0.3, you're going to see that 6.5 where we are now come down very quickly to the 4s. So that, if the Fed reacts quickly enough to that, as long as they're not stuck in this mantra of we have to get to neutral, we have to do 9 or 10 hikes, if they react to the core, ignore headline. You can't do anything about food and energy prices. You can only impact demand. You can't change food and energy. In actual fact, in any normal cycle, a central bank would ignore commodity price increases caused by geopolitics because it's a tax on the consumer. It lowers future demand. So in a normal time, they will be looking through that totally. They can't now because we're starting at such a high level. But if core is coming down by June and the Fed do pivot and they do react quickly, then that would be the most positive scenario for me.
Well, there's been encouraging news lately on the supply of labor and maybe even some of the other supply side constraints. Does that factor into?
Yeah, I'm not worried about wage inflation. We have negative real wage growth. I do not believe, and this is one of the reasons why we've had negative, very low inflation in the last 30 years, is, real incomes have been squeezed. We haven't had wage growth. And yes, we saw last year, we saw this shift in the balance of power in the labour market to the employee from the employer. I think it was temporary. I think wage pressures are already starting to ease. And unless you get wage inflation, you can't have persistent inflation because the only real form of inflation is the wage price spiral. So if the labour market remains behaved, you will see inflation pressures come down. It's just whether the Fed react to it and they don't listen to the likes of Bullard and they listen more to the Brainards of this world.
Okay, great. Last question. Thank you.
Two questions, one on equity and the other one on fixed income. Do your organizations have a target for the S&P 500 for year end? That would be the first question. And the second question is, one of the few bright spots in fixed income has been the whole loan floating rate area. Did you see any concerns there? Do you think that will continue to work?
I don't have an S&P forecast. Do you have one?
We don't have a forecast. One way I can answer that is we have an asset allocation policy. Currently, we're underweight equity.
I think the S&P will end the year lower than it is now. Yeah, I don't think we've seen the lows for equities yet this year, but then that's coming from the English pessimistic bond. The housing market, it's going to, price increases are going to come down from here. We're already seeing that in the mortgage applications, and mortgage applications tend to lead house prices by about 12 months. On the other side of it, there's a lack of supply, right? There's been a lack of construction, there's a lack of supply. So I think the housing market will be fine. We're not going to continue to see the increases we're seeing now. So you're going to see it slow, but affordability becomes an issue again. And this is, I was looking at, if you look at a median house, in 2021. So 20% down payment, median house price, 20% down payment, given 30-year mortgage rates then, your mortgage payment would have been $1,200 a month to buy that median house in the US. You do that today, given mortgage rates at 5% where we hit today, given the 20% increase in house prices we've seen over the last 12 months, that same house, the cost is $1,800 a month. So that's a 50% increase in the mortgage rate. That's the problem. As I said, it doesn't mean prices collapse because I think we have a lack of supply, so there'll always be some demand to meet that supply. But you're going to see house price gains slow. It's not a bad thing. You know, you've got to keep a relationship between house prices and incomes. That relationship has to maintain. And I think one of the concerns I have in the housing market is it's become a much increased investment tool. So again, that search for yield we talked about before, it's spread out into the housing market, and you've got certain companies that are now the biggest landlords in the country. That's a distortion that worries me. But in terms of sort of REITs and in terms of housing-related bonds, they're going to continue to be fine. This is not 2008 for sure. The leverage isn't there.
Do you have a view on floating rate bonds?
No, not really. I don't look at floating rate notes. I must admit, I'm on the fixed side.
Thank you.
Okay, well, great. Chung, Emily, and Lee, thank you very much for your time. And yeah, no, as a token of our appreciation.
Thank you.
Thank you very much. Thank you. Thanks.
Thank you. Appreciate it.